Here's what's coming up on today's show.
So, when you start looking at it, health insurance, the cost of medical care, Jennifer says it all the time, you'll spend $260,000, $280,000 in retirement on medical costs. And this is a big part of the cost.
Welcome to the How Money Works podcast with Craig and Jennifer Moser of Maestro Wealth Advisors, serving you throughout the Triad of North Carolina for more than 30 years.
Time once again to learn how money works with the great team from Maestro Wealth Advisors here to talk with me about investing, finance, and retirement, and serve you in the Triad. So get yourself onto the calendar. Come on in for a consultation and a conversation with Craig and Jennifer Moser and the whole team at Maestro Wealth Advisors. 336-448-1086 is the number to call to make that happen for that no-cost, no-obligation consultation and conversation about your financial and retirement journey. 336-448-1086 to sit down with the team. Craig's been doing this for a long time. He's a financial advisor and certified financial planner, and Jennifer's been right there by his side as a certified exit planning advisor as well. So get on the calendar and get started today. And we're going to talk about changes in the financial information and numbers in the new year now that it is upon us and rocking and rolling. Guys, welcome in. Miss Jen, how are you?
I am great. You know, what's the thing that's constant is change.
That's right.
So, but we're doing good. Starting a new year, I cannot believe that we're into the new year and pretty much through half of the first month already. So,
Time flies.
Things keep marching.
So how many people have gone to the gym?
I have. Ooh.
Yeah, nice.
And I have a New Year's resolution.
Isn't it this weekend?
I've been working out. Dude, I've been working out every day. It's been great.
Yeah.
And she walks into the office on Thursday, and there I am shoving apple pie in my face.
Yes.
Just wolfing this stuff down like a pig.
Nice.
And I'm like, yeah, I'm working out now. I'm exercising.
And what he doesn't tell you guys is that he had 2 slices of apple pie. And I said, well, you had 2. And he goes, well, really just 1 big slice.
Oh, okay.
I
like
expanded the first slice just a little.
Well, I think it's this weekend that it's the quit weekend. I think most people give up their resolutions by this weekend.
Already?
Yeah.
Oh, we're so short-sighted, are we not?
We are, for sure.
I started hitting the heavy bag, and my hands are all bruised up.
Nice.
I've forgotten. I can hit hard, but my hands are soft. It hurts.
You start forget you're getting older, right? You got to be careful. So
yes, sir.
Well, let's hope everybody's had a good new year, and hopefully they're not quitting yet. But one of the things people do make changes on, guys, is they want to get better healthy diet and finance, right? Mm-hmm. So let's talk about some of the adjustments to think about for the numbers changes that the government gives us yearly, and how that might affect us. And let's start with the COLA, the cost of living adjustment, or as my mom likes to say, because she's on Social Security, the diet COLA.
Diet Cola. That's great.
Because it's never very good. Yeah.
Actually, it was in 2008 through 10. It was diet.
That's true.
Anyway.
Break it down.
Our Social Security checks, you got a raise this month. It's about 2.8%. So that's good. If you are seeing a higher check, that means that you might be able to track some with the things that are costing more. If you think about it, good gosh. Everything's going up so much because they printed a boatload of money. And so it's nice to get a cost of living adjustment on your Social Security. Hopefully that's not all of your money, but you know how it is. The bigger increase that people received, what would they do? They got a higher increase in 2025, didn't they, Jennifer?
No, it was lower in 2025. So this is a bigger increase than they received in 2025, but lower than 2022 and through 2024.
I gotcha.
So, but we in our modeling calculations, when we look at it, we usually use only about a 1% on Social Security, just because we don't want to overstate things and really keep up with the true cost of living on everything else that's out there. So we do try to make the spread, but 2.8 is not bad. That's another, reason to potentially delay some Social Security taking, so you can get the higher cost of living on a higher balance. So, but you know what they say: the government giveth, and the government taketh away.
And that's where the diet comes in, right? Because the Medicare premium changes. They're going
exactly.
Yeah.
So Social Security goes up, but then your Medicare premiums probably have gone up as well. And so it may negate some of that increase.
Maybe you can stay even. So if you are the standard person, I don't know what the income level is, below 190,000 as a couple or something like that, your Medicare Part B premium, what you're being charged is $202.90. So it went up. It's like, well, it's almost 10% from the $185 per month in 2025. So it's the second largest dollar jump in program's history. So just be aware, stuff costs more, and that's why you have to have your portfolio set up the right way to be able to cover this. And here's the crazy thing.
Yeah.
If you are a married filing jointly couple and your income is over $750,000, which there's a lot of people out there that make that kind of money, $689.90 for the same thing that somebody will get for $202.90. So think about it. If you make a bunch of money, you pay more for the same thing. Yeah.
Same services.
Yeah, that's B,
Medicare.
right? And then you got
Right.
Part D, which is like another $100 at that, thing.
$91.
Right.
Yeah.
So, when you start looking at it, health insurance, the cost of medical care, Jennifer says it all the time, you'll spend $260,000, $280,000 in retirement on medical costs. And this is a big part of the cost.
Yeah. And one thing that we work with clients, we give you an issue, but then we hopefully provide some kind of a solution, right? So when you do come in to talk with us at Maestro, we look at how do we manage your tax line or your income to minimize some of these things. So people talk about Roth conversions a lot. How much do I do a Roth conversion? What's the cost of it? One of the components that you need to think about in those Roth conversion calculations is not just what is my federal tax and my state tax in the year I convert, but what's the implication to these Medicare premiums and
Social
Security taxation. So there are ancillary, side effects. When you make one change to a plan, you have to look at everything else. And that's why it's really important to work with a financial advisor and look at these things before you make that decision, before that decision becomes an oops, I wish I didn't do it.
When we run the tax software, a lot of times what happens is we can show you what happens if you take money out of the IRA or 401k. So I take this out, Uncle Sam gets their fair share if it's fair, and then it grosses you up. So if we have done a good job maybe converting over to Roth IRA over a period of time, not all in one big lump sum, when you take money out of that Roth, no tax, which means Social Security may be taxed less, or a lot of the Social Security might be tax-free. These are all things that when we sit down with you, talk with you, start to do some planning before, we'll end up getting to the investment part, but the planning part is how we get to that. So if you can see this in your mind that I need to get my plan in place first, give us a call. It's 336-448-1086, and let us spend some time with you to go through different scenarios to help you to be able to see, if I do this, I improve what I keep. If I don't do this, okay, maybe I can afford it, but do I want to pay that much more out of my own pocket?
And let me, as you're listening, and that number is really good to remember, 336-448-1086. Give us a call at your convenience, but do not procrastinate. But a juicy morsel you may not know is this Roth conversion. A lot of people are talking about Roth conversions, and they've got a lot of money tied up in their 401ks, right, Craig? If you've got your 401k and your Roth, if you move that money out of your employer plan and move it into a brand new Roth IRA, because you've never had one before, and then you roll it into your IRA, that Roth IRA clock that has to be running at least 5 years, and you be 59 and a half before you can pull every dollar out of that Roth tax-free, starts ticking right then when you do that conversion. So one of the things we work with our clients is, how close are you to retirement? Do you have that Roth account started outside? If not, let's seed a little bit of money into a Roth IRA held at a bank or a financial institution if it's not very much. Or if it's a little bit larger, we can do a Roth, investment account. Start your 5-year clock running. So then in the 5th year, when you're ready to retire, you roll over a boatload of Roth money into it. Then it's immediately seasoned for that 5-year period. You've probably already 59 and a half, and then every dollar you pull out is tax-free. If you've not thought about it before, that's part of the planning we do and the things that we think about and we give you some advice on. Again, our number, 336-448-1086. If your financial advisor isn't talking to you about this, they need to, because it could be a lost opportunity and a tax consequence for you, and we don't want that to happen.
Yeah.
Let's talk.
I was going to say, Jen, and boatload is the official term, right?
It is.
Yeah,
it is.
so.
I mean, a boatload. But, because if you're listening to our show, we highly encourage people to put money into that Roth component of their 401k. Take a little bit of a tax hit. Craig, I didn't really share with you, but I sat on a webinar with Ed Slott, who is the genius guru, tax guy for IRAs and that kind of thing. I mean, the whole industry looks to him for advice. And man, you think I talk fast? He can belt it out there. But so he was talking about, it's not a matter of you paying taxes. It's when you pay taxes. You're going to pay taxes, but when you pay taxes, and then are you paying it at the lowest possible rate that you'll be paying?
That's really the strategy, because I don't know if a lot of people are pretty tax savvy, and some people go, I don't understand how the thing works. I'm in a 22% tax bracket or a 32% bracket. That's your top dollar. This thing starts at 10, 12, 22, 24, and moves on up to 37, and it's progressive. So each block of money goes into a different tax cost, if you will. So planning this out and making sure you understand how to best structure this. With the money that I'm going to convert over, how do I not creep maybe into a tax bracket that costs me another 10%, something like that. These are the strategies that we're going to help you to work through. Again, our number is 336-448-1086. We'll be happy to talk to you. Call somebody on our team, get an appointment with Jennifer and I, and we'll go to work for you.
Get yourself onto the calendar, check out the website, do lots of cool stuff there by visiting them online at maestrowealth.com. That's maestrowealth.com. You can subscribe to the newsletter, check out the podcast version of the program or the YouTube channel, which will be adding some more content in this new year. So make sure you go check that out and hit the subscribe button. Lots more coming down the pike. But if you need some help, again, just reach out to them. One of those two ways, online at maestrowealth.com or at 336-448-1086 for that complimentary consultation and conversation about your retirement structure. 336-448-1086. Again, 336-448-1086. Guys, we're going to pick up our conversation again where we were talking about changes in the new year from the fiscal numbers and the different things we need to know. And as the passing of our Uncle Obaba, the One Big Beautiful Bill Act, earlier in the year, all that stuff's taking place. You can, since you're filing for last year, we want to make sure that we're taking advantage of those tax deductions for seniors and those little extra things they added this year. So break it down for us.
Well, like you said, break it down. Kind of threw that right in my lap.
There you go.
So have you heard about the $6,000 that you can add to your standard deduction? And that's a maybe, but it's a pretty good maybe. So if you earn as a married couple under $150,000 modified adjusted gross income, come see us and we'll show you how that works, then you're going to be able to pick up an extra $6,000 if you're over the age of 65. So for a married
per person, yeah.
For a married couple, that means $12,000 in total. If both spouses qualify this year. To qualify, you must turn 65 before December 31st. It's a pretty fair thing. You could be 64 up to 12/30, and then the very next day you're 65, and you will be able to take advantage of that. If you earn over $150,000, it starts to phase out. So when you hit $250,000 of income, you don't get that $6,000 per person or whatever it is. But I mean, you're talking, $47,500 or something if you do the full standard deduction and you're both over 65. That's a lot of zero tax if you stop and think about it.
So
in that case, the first $47,500 is zero tax if you're just using your standard deduction over the age of 65. That's pretty great.
And for our single listeners, that modified adjusted gross income to get the full $6,000 tax deduction is $75,000. So if you're 65 and above, single tax filer, as long as your income is $75,000 or less, you get the full $6,000 in addition to your single payer standard deduction.
Yeah, and it phases at 150, I think. So yeah, it phases from 75 to 150. Yeah.
This is a new thing this year, so it's something to take advantage of.
Well, it's actually last year too. Remember, there is a last year. So 2025, you'll be able to get that on your 2025 tax return, and this will be a new year.
Because it was July they passed it, right? Yeah.
Yep.
Right.
So not so bad. And then if you're a charitable giver,
if you're a charitable, I was going to say, you're taking my thunder. So you have an additional amount that you can take if you're a standard deduction taker. If you're a single person, you can take an additional $1,000 in charitable donations. If you're a couple, you can take $2,000 of charitable donations in addition to a standard deduction and hopefully this senior deduction. Now, Craig, on the senior, that's what people were talking about, the Social Security.
Tax-free Social Security.
Yeah,
well, it's not.
Right.
But it sure puts a dent in it.
So that's what, if you're thinking, wait, I thought I got free Social Security or whatever, this is what the tax bill is addressing and giving you is this extra tax deduction. So
that's all. This is good stuff. That one big beautiful bill helped a lot. Another thing, if you're over 50, you have more opportunities for catch-up contributions. Now, what's a catch-up? That's not what you spill on your shirt. When you're eating a hot dog, I contribute to a retirement account. So when you're putting money in a 401k, a 403b, a 457, right now, the amount that you can contribute in 2026 is $24,500 if you're under the age of 50. So if you're over the age of 50, you can toss in another $8,000 on top of that. So you can either pre-tax or contribute to a Roth 401k, either one of those, $32,500 each year. For employees that are 60, 61, 62, and 63, there's a super catch-up.
You got to love that title, super
I don't know who named this. It's really
a little spicy ketchup.
It's really a big deal. It's an additional $11,250, making the total contribution cap $35,750. So let's say that you run your plan analysis and you're an empty nester. And you're looking at it and I'm behind. I need to save more money for old me so old me can retire and live a long time and not have to go back to work. Now you can chuck in $35,750. It's probably not your most favorite thing to think about, but you can get a bunch of money back in a qualified company-based retirement plan. It's a pretty awesome thing when you start working through the numbers and saying, how do I make all this work? So when you sit down with us, what we're going to do is say, let's look at what you've already saved. Let's look at your sources of cash flow, the things that are going to pay you when you stop working, a pension, Social Security checks, maybe if we can put in the rental income. The problem with rental income is it's not pure. How much of this do I take in? But then I've got property taxes, I got property insurance, everything breaks, I still have to fix it, and that comes out of the payment, but nonetheless cash flow. And then what we're going to do is say, here's what we have, and here is how we measure this against what we want. Mm-hmm. So pretend that you need $150,000. And from your 2 Social Security checks and maybe a pension, you've got 90,000 of it. Well, you've got a lot of it beaten. Your money that you've saved has to pay that gap, cover the difference. So what we're looking at now is how much will I have to pull out? So one of the things to think about is what's the payout ratio? If I'm taking out 15%, you're going to kill it. But if you're taking out 4 or 5%, we can probably keep that going forever and a day. If not, we'll have to work on it. And then the other part is, what is the tax cost to access the money you have and wherever you saved it? Most people have saved in that 401k because it's easy and it's what you're supposed to do. Pay yourself first and grow your money. So that's a 401k type idea. But then if you grew that in pre-tax, you've never paid the tax on it. If it's a big number and you need money out of that, how much is it going to cost you to access that money? So we need to run that for you. You need to visualize that in today's tax rates. You also need to visualize that if they raise the tax rates in the future, because our government, who are we kidding, Jennifer? I mean, these guys owe a bunch of money.
Yep.
So
Yes, they do. Yes, sir.
sort of
A boatload of money.
A boatload, yes.
this boat's a sinking.
Yeah.
So anyway, what I'm trying to get to is I suspect they're going to charge us more for taxes later. I just think. I mean, there's no guarantee on that, but as you're looking at it, come on.
And that and then also the ancillary services that you're getting and how those things. We talked about that for your Medicare Premium Part B and D, and whether your Social Security is taxable. All of these things key into when you're taking money out, what tax source are you taking from, and how does it impact your ultimate bottom line?
Isn't it amazing to you guys how much the conversation goes to taxation? I mean, you think in retirement, I save this big old pile of money. I'm going to get these Social Security checks. Maybe I've got something else coming in. And then you go, how much do I get to keep of this? And what are they going to charge me for the things that I thought I already paid for, like Medicare? Didn't you pay for that in your paycheck? I don't know. When I look at my paycheck, it comes out every time.
That's right.
But still I'm paying, and they being the government, determine how much I pay for those items. The government determines how much I will pay in the future, you will pay in the future, for taxes to take the money out of an account that really has never seen taxes. So you need to look at this. Let us run this for you now, so that you have an idea what it's going to feel like when you get to 73 or whatever the required minimum age is for your minimum distributions, and we start to have a plan. How do I avoid this if I want to, if I need to? When should I turn these switches on for income? I mean, everybody looks at the Social Security. I'm 62. I could turn the switch on. I could get a check. I understand, but is that the best move?
Right.
What's best for you? So working with us, we take the time to go through this. We
do.
really do. So give us a call, 336-448-1086. Get on the calendar and let's take a look.
I will say, new this year, for those higher wage earners, and a higher wage earner is someone who has had $150,000 in FICA wages in 2025. If you do want to do these catch-ups, the government's going to make you put it in a Roth contribution, not do a pre-tax contribution for those.
Yeah.
So the government's kind of helping some people out with this tax planning, because the government says, we're in trouble, we want some money, right? So they want it to be taxable.
But if you do it, you'll get tax-free later.
Well,
right, you will get
and
tax-free
Jen, that's
later.
a great point, because the Secure Act 2.0 put that in place. So if your company doesn't offer a Roth 401k, you can't do the catch-up. Unfortunately, yeah.
Right.
So
that's another thing. I mean, employer plans, it's basically if you don't have a Roth contribution, go to your HR and say, why don't we have a Roth capability? And if it's something that the employer has an issue or whatever, we do company plans as well. We could probably put something in place to allow that Roth contribution if your current advisor, to that plan isn't doing it. But that's a good point. Roth contributions have to be, those supers have to be Roth if you're a high wage earner. We've talked a lot today about things that are changing this year. This is just the tip of the iceberg. But the real question is, what's going to change in your financial life? Are you going to take control of your own finances to make this year the year that you understand retirement and actually plan for retirement? It's a decision, just like a decision to go to the gym or a decision to put something in your mouth. I'm making those decisions now, right? So that's why it's top of mind. Give us a call, 336-448-1086. Let's make a change in your life, and it's up to you. Pick up the phone, 336-448-1086. We would love to sit down and talk with you and understand more about you and share what we know.
All right, folks. Well, thank you once again for your time here on How Money Works with Craig and Jennifer Moser. Again, don't forget to reach out to them for that complimentary consultation and conversation. No cost, no obligation, no reason not to pick up the phone and get started in the new calendar year. 336-448-1086. That's 336-448-1086. 888-267-1486 to get started today, and we'll see you next time here on How Money Works with the team from Maestro Wealth Advisors. Thank you so much for checking out the podcast today. If you have any questions about what we've discussed, remember, you can get a complimentary financial review with the team at Maestro Wealth Advisors by calling 336-448-1086 or go online to howmoneyworksradio.com for other great resources and ways to reach the team. You can also check the show notes of today's episode for our contact information as well. And don't forget to subscribe to the podcast on your favorite app so you never miss an episode. We're on Apple Podcasts, Spotify, Google Podcasts, and all the most popular apps. For Craig and Jennifer Moser, I'm Mark Killian. We'll talk to you next time on the How Money Works podcast.
Securities offered through Cetera Wealth Services, LLC, member FINRA SIPC. Advisory services offered through Cetera Investment Advisors, LLC, a registered investment advisor. Cetera is under separate ownership from any other named entity.